the most basic, simple way of describing is that central banks aren't going to go back to buying treasuries and selling gold. I think that from here on out, you're going to see more turbulence, more volatility, sharper swings, but nothing's really changed. In fact, I just think you have to not get shaken out. The bull wants to take as few people along for the ride as possible, and you have to keep your perspective. They try to tell us that this was the Chinese dumping like 1 million ounces of gold. Let's just put that in perspective. So first, when we talk about Chinese gold-backed ETFs, in the month of April, they saw more inflows than all of 2024. And that's just in the first 11 days of the month. When we talk about China dumping gold, first of all, their markets are closed right now until May 5th, which is very peculiar. In fact, this lends itself to making you think of conspiracy and of manipulation and of suppression during Chinese trading hours when their markets are closed. That's a clever trick. To me, that's very suspicious, to say the least. And Goldman Sachs' story is very suspicious. And I think the bullion banks were able to exploit the closures in the Chinese markets to smash the price. If you look at a chart, a continuous 24-hour chart, you see it go up every time it hits Chinese trading. It goes up and gets smashed as it comes into New York. Well, suspicious. Goldman talked about a 31-ton dump, but they didn't make any delineation between the Shanghai Gold Exchange and the Shanghai Futures Exchange. So I did a little digging. The Shanghai Gold Exchange delivers less than 4 tons a day. In essence, the majority, if not all of this dumping was done in the futures market. And so I think that that's important here. You're not seeing physical gold being sold off. You're seeing futures being sold. It's done for effect, for sure. Let's talk about what's happening here in the United States. We saw for the May contract in gold, 9,306 contracts stand for delivery. That's the second highest ever for a non-active delivery month. The silver May contract, 14,813 contracts stood for delivery. That's the second highest ever, just behind March's record delivery. And we're beginning to see these short positions that are closing their positions, and you knock it down, and yeah, a good way to close it. But it seems everything's settling for physical delivery. The other side of the short, the long, says, great, we'll stand for delivery, please. Who are those longs? We don't really know. But to me, this just exemplifies continued demand at the highest level. So I think people need to put things into perspective. It's been quite a run in gold. Silver hasn't begun to blow out from its technical formation. I suspect it will, and probably much more so than what we witnessed in gold. But I would just simply say that it's going to be bumpy, but nothing has changed, not even a little bit. And with the Fed meetings and all the things that are happening, I think perception, this was a perfect opportunity for, if I had to guess, the Western bullion banks to knock the hell out of the price, say it's the Chinese, even though their markets are closed, do what they can to close out their short positions, or to, settle things with metal that they're able to then physically buy on the cheap. So this doesn't bother me at all. It, nothing goes straight up. It's certainly violent, but also put it in perspective. A $60 or $70 drop is 2%. So it's not a massive drop. The dollar numbers are higher than most us gold bugs really think about, because it hasn't been at these levels for very long. And when you're at 3,000 plus gold, a $300 move, it's still 10%, but it's a big one. But when you see $60 or $90 move, which really freaks people out, you're talking under 3%. So you're going to see paper market volatility. That's just the bottom line. You're going to see that the higher the price goes. But I still think gold and silver will climb the wall of worry that everyone is freaking out about on social media right now.
You're going to understand why the latest volatility in gold prices, while noisy, theatrical, and even painful for some, is just the latest magician's sleight of hand. It's smoke, it's distraction, it's a setup to shake you out of your conviction just before the biggest monetary reset of our lifetime becomes visible to the world. You have to think bigger. You have to think like the central banks, like the sovereign wealth funds, like the insiders who never react emotionally to price action because they're playing the long game. Now let me say something right off the bat. Central banks are not going back to buying treasuries and selling gold. That era is over. That's not my opinion. That's observable behavior. In fact, I'll take it a step further. We are witnessing a complete reversal of post-WW2 monetary policy. Since 1944, the world has revolved around treasuries. That's changing, and the bullion banks know it. So let's put this latest round of price suppression into perspective. A few days ago, we saw this narrative pushed out from Goldman Sachs. Something about the Chinese dumping 31 tons of gold, right? They made it sound like China was liquidating physical gold like it was a distressed fundraising cash. But when you dig deeper, none of it holds water. First of all, China's markets are closed until May 5th. So if you're telling me that this price action was caused by Chinese selling, you've either got your dates wrong or you're deliberately misdirecting the public. Because when trading is closed, you can't sell. Not in the physical market. That's not how it works. You can't dump physical metal you can't access. Second, when you actually look at where this so-called dumping took place, it's not the Shanghai Gold Exchange, which handles actual delivery of physical metal, less than 4 tons per day on average. It was in the Shanghai Futures Exchange. Big difference. One is real metal changing hands. The other is paper claims being traded for effect. And that's exactly what this was. A futures dump engineered for price impact. So why does that matter? Because futures can be used to move price without moving metal. They can be dumped into thin liquidity during off hours to maximize the effect. And with China offline and Western markets in full swing, this was the perfect setup. You saw gold lift during Chinese trading windows and get smashed as soon as we rolled into New York hours. That's not organic selling. That's a coordinated trade designed to flush stops, shake confidence, and close out short positions while the price was down. And guess what? It worked. The social media fear meter went red. People freaked out. People sold. Mission accomplished. Except for one thing. The demand didn't go away. Not even a little bit. In fact, if you look at the delivery side of the equation, the story is completely different. Let's talk about May gold contracts. We saw 936 contracts stand for delivery. Now that may not sound like much unless you know the context. It's the second highest delivery volume for a non-active gold month in COMEX history. Translation? People are calling the bluff. They don't want to roll over their futures contracts. They want metal. They're saying, give me the gold. And it gets even better in silver. The May silver contract had 14,813 contracts stand for delivery. Again, the second highest on record, only behind March. That is staggering demand for physical in a supposedly quiet month. And that tells you everything you need to know. The price action is one story. The behavior of actual market participants is another entirely. Now let's talk about what that means. It means the shorts, those who were using paper to suppress price, are being forced to settle. And more often, the longs are not rolling over. They're saying, no thanks, I'll take the bars. And when you've got a rehypothecated system where 10 claims exist for every real ounce, that becomes a very big problem for the shorts. So who are these longs? We don't know for sure, but we do know they're big, they're consistent, they're serious, they're not tourists. This is sovereign type behavior. This is institutional type behavior. And it tells me that real physical accumulation is intensifying, even as the paper market is being used to scare people out. Now I want to shift gears for a second and talk about the emotional impact, because I get it. Gold's up $300, then down $70 in a single session. It feels violent. It feels manipulated. It feels like a rug pull. And that's by design. This market isn't designed to be fair. It's designed to take the fewest number of people to the finish line. The bull doesn't want company. It wants the few who had conviction. And that's why I always tell people, you have to zoom out. You have to keep your perspective. When gold drops $90, you say, wow, that's huge. But at $3,200 gold, that's a 2.8% move. If the stock market drops 2.8%, they call it a correction. In gold, they call it a collapse. Why? Because they want you to think it's risky. But volatility at higher prices is just math, and we're only just beginning. The truth is, nothing goes straight up, especially not gold. It climbs the wall of worry. It climbs despite the fear, the manipulation, the fake narratives. And each pullback shakes out the weak hands, resets the market, and lets the real buyers accumulate at better prices. And that's exactly what's happening now. The Fed's still boxed in. They're still dealing with an inverted curve. GDP is still negative. Layoffs are still increasing. Treasury yields are falling again. And the Fed's dual mandate, employment and inflation control, is starting to fray. They can't fix both, so they'll pivot. Maybe not today, maybe not this meeting, but they'll pivot because they always do.
All of these things to me are peripheral noise. No, it's not. That doesn't change the structural problems that we have with the monetary system, with our indebtedness, with everything. But and we should hope for peace, certainly. But no, I don't think that changes anything at all. In fact, you could argue that when the war is over, you may see a larger, more concerted effort by the BRICS nations to focus on unity, to focus on trade. And we talked about last week, 40 plus countries have applied for the BRICS, Vietnam being the last. And their new payment system, which is now open to non-member nations, they haven't slowed down behind the scenes. They're just not as open about it anymore. And the Russian finance minister is all over the place, Lavrov, talking about this. And so peace is good, but it should not have anything really material to do, in my mind, with the price of gold. Really, it shouldn't. Even if it ended today, I don't see how it materially impacts the United States, the dollar, or any of the problems that are fiscally or monetarily in front of us.
Any comments from you on the concept that some retracement to Fibonacci levels is normal and healthy in a bull market?
100%. Richard Russell, I'll make it easy because the Fibonacci numbers, I don't know off the top of my head, but yes, that is true. Richard Russell always used to say at least a 50% retracement. When you see things move up that high, a 50% retracement is normal. And it is normal and healthy, with somewhat of a gold squeeze. It moved a little too fast. It was exciting. And, we were all thrilled by it and expected it to go straight up forever, but it won't be that easy, not even a little bit. But take a step back again. And you got Treasury Secretary Bessent saying that the bond markets are signaling it's time for the Fed to cut rates. Well, they want to go back to, more easy money and perhaps even quantitative easing. Again, this is very gold friendly. Powell didn't say flat out that he's going to abandon his dual mandate, but he hinted at it. In other words, they're caught. And they know it. We're caught between the ability to fight inflation and to keep rates low enough to stimulate the economy. You're seeing mass layoffs. You're seeing a slowdown in the economy. And so I think, what do you do? I think Trump wants lower rates. He wants a lower dollar, as we've seen. And now you have the Treasury talking about coming in and buying their debt as well, finding ways to buy older maturity debt. Again, this is all monetization. We saw the negative print on the GDP, right? And so the 2-year Treasury yield is 3.56 right now, but the federal funds overnight rate is 4.33. This is more of what we saw before. This is classic yield curve inversion. This screams of a recession coming, with inflation fears elevated already.
So let's continue. We've laid out the trap: massive delivery demand at COMEX, paper market smashdowns conveniently timed during Chinese holidays, and suspicious dump stories that fall apart under the light of scrutiny. And yet the price still climbs, because the people accumulating metal right now aren't flippers or newsletter traders. They're building a position for the next system. Now, what's happening at the macro level is just as critical. Let's talk about the Federal Reserve's corner, because they're out of options. On the one hand, you have persistent inflation, not transitory, not decelerating fast enough. The CPI may print soft occasionally, but real-world inflation, insurance, food, shelter, is sticky and everywhere. On the other hand, you have a slowing economy. GDP just printed negative again. Layoffs are ticking up. Manufacturing is contracting. The Fed can't fight inflation without raising rates, and it can't raise rates without breaking the economy or the Treasury market. That's the box. And that's why Powell is hinting at data dependence, a pause, a wait-and-see approach. But make no mistake, when push comes to shove, they'll cut. And when they cut, it will unleash the next phase of the gold and silver bull market. But even that misses the bigger picture. This isn't about a Fed pivot. This is about the world walking away from the dollar. And here's where we talk BRICS. Over 40 countries are now either formal members or in the application process to join the BRICS economic bloc. Vietnam, Turkey, Egypt, Saudi Arabia, Argentina. The list is growing fast. These countries aren't just joining for photo ops. They're joining to build a parallel trade settlement system that doesn't rely on the dollar. And it's already live. BRICS is now testing cross-border payments in local currencies. They're openly discussing a gold-backed settlement unit, possibly tied to a basket of commodities, and they've made their platform open to non-member nations. That's a game changer. It's no longer about BRICS versus the West. It's about any country having an exit ramp from dollar dependency. You think central banks don't see this? You think they're not planning for it? Of course they are. That's why central bank gold buying hit a 55-year high in 2023 and continues at record pace in 2024 and now into 2025. That's why sovereigns like Singapore, Turkey, and China are gobbling up gold hand over fist. And that's why Western central banks are quietly importing gold. While the headlines scream, Chinese selling, it's all upside down. And the silence is deafening. Ask yourself this: if gold wasn't important, if it wasn't coming back into the system, if it wasn't about to play a central role in the new global architecture, then why is everyone trying to get their hands on it? The United States, for the first time in decades, is importing more gold than it exports. Not just a little more, tens of millions of ounces, much of it via JP Morgan acting on behalf of a client. Could be the Fed, could be the Treasury, could be a foreign sovereign, but whoever it is, they're getting the real thing. You don't do that unless you know something, and what they know is this. The end of unbacked fiat is closer than most realize. Let's tie this back to the idea of revaluation. If you want to reset the system, you need to anchor it. And gold is the only anchor that works. Every other option is trust-based. Gold is trustless. It doesn't need a central bank's promise. It doesn't default. It doesn't dilute. So how do you do it? Simple. You revalue gold higher, say to $5,000, $10,000 or more, and you peg future debt issuance to that value. You say, here's a new treasury note redeemable in gold at $10,000 per ounce. Boom. Instant credibility, instant demand, and instant devaluation of existing debt. That's the kicker. By raising the price of gold, you shrink the real burden of legacy obligations. This is exactly what Roosevelt did in 1933. He seized gold from the public at $20.67 and revalued it to $35. That was a 41% devaluation of the dollar overnight. Same playbook, different century. And Nixon? He just completed the process. He closed the gold window and untethered the dollar. That let debt run wild for 50 years, but the bill has come due, and the only way out now is another reset, and gold is the linchpin. Now you might ask, Andy, why aren't we hearing about this in the news? That's the whole point. You're not supposed to hear about it until it's done. The insiders don't advertise their moves. They execute them quietly. Then they announce the new rules. And that's why I've said all along, gold is not reacting to anything. It's being reintegrated into monetary architecture, reintegrated into debt instruments, reintegrated into sovereign clearing. It's not speculative anymore, it's strategic. And those of us watching can see it happening in slow motion. Every COMEX delivery, every central bank purchase, every reclassification of gold from a tradable asset to a Tier 1 reserve. Now, what does this mean for silver? Well, silver is the canary in the coal mine. It's the smaller, more volatile sibling, but it follows the same rules. We're already seeing it break out of long-term technical patterns, and once industrial demand intersects with monetary demand, watch out. It won't just outperform gold, it will melt faces. That's not hyperbole. That's what silver does in bull markets. It lags, then it explodes. And with physical premiums rising and COMEX inventories tightening, the setup is there. We just need the spark. And you know what? It doesn't take much. All it takes is one failed delivery, one short squeeze, one sovereign moving in size. That's all it takes to light the fuse. Which brings me to the final point. If you've been sitting on the sidelines, waiting for clarity, this is it. The window is closing. The big money has already moved. The system is changing. The media may be silent, but the flows are loud. If you're paying attention, you can hear it. The rumble of a new monetary world being born. So what do? You get physical. You get out of the paper promises. You trust what you can touch. You prepare now before the new rules are announced. Because when they flip the switch, when gold is $5,000, treasuries are partially backed, and the brick system is live, you won't get a second chance to be early. This is the moment. Ignore the volatility. Ignore the fear. Ignore the headlines. Focus on the fundamentals. Gold is telling you what's coming. Believe it before everyone else does.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.